So this is 60% return in just about 4 months. This is a stock that one of my students in the US has bought. I don't personally trade the US market. This is a stock in the Nasdaq exchange, and one of my students bought it on 19th of April. That's the yellow line is that buy point. Okay. And he's still holding on to the stock. He hasn't sold a single share. And the price is up 60%, as you can see. So let us discuss this trade. Why did he buy here? This is 60%, okay, in about 4 months. So from 19th April till today, as I record this video, today is 31st August. So this is 30th August, last closing price, okay? Let's discuss this trade. So let's see, what did he see before the breakout? What is it that he saw? This is what he saw. Let's draw the base. Number one, my first criteria is that the stock has to be in a stage 2 uptrend. So stage 2 means the price is above the 50-day moving average. The 50-day moving average is above the 150-day moving average, and the 150-day is above the 200-day moving average. So that the basic criteria is met. It's a strong stage 2 uptrending stock. Now within stage 2, as we have discussed earlier, there is early stage, middle stage, late stage. We will discuss that later in this video. Okay, I will cover that point as well. But for now, just understand that this is a stage 2 uptrending stock. I will remove the moving averages. So that's condition number one, that is satisfied. Second, let's draw the base. Very nice. This is point one, this is point two. Very nice, tight basing formation. Okay, the price is consolidating in a very tight range. If I put the bar chart here, see how tight the price action is. And if you notice the downfall from point one to point two, the stock has lost only 7.8% from the top, which means this stock is so strong that it is not given up even 10% of its return, okay, from the top. It has given away less than 10% of its return gain from the top, which is fantastic. This is called as a A-grade base. If the correction is 10%, I call it A-grade base. If the correction is 10 to 20%, that is B grade. If the correction is 20 to 30%, that is C grade. And if the correction is 30 to 40%, it is D grade base. If the correction is more than 40%, I don't buy the stock. Okay. I might buy the stock, but it has to tighten up very nicely on the right-hand side. And the position size would be small in such extreme cases. Okay. And a correction more than 40%, it has to be caused by a big decline in the general market. But that is a topic for some another video. Let us focus on this stock. By the way, before I discuss further, this company is SFM. This is called as Sprout Farmers Market. You might not have heard about the company. However, if you notice, if I click here, if I click on financials, okay, the market capitalization of the company is $10.42 billion. So it's $1 billion company founded in 2002. So it has been around for more than 22 years. Okay. $10 billion market capitalization. Okay. 32,000 employees. So you may not be aware. If you are outside the US, you might never have heard about this company. But when you look at the data, it's a $10 billion company. Engages in the operation of healthy grocery stores. So basically it's a retail chain, healthy grocery stores, where you have supplements, meat, seafood, things like that. Okay. That's the basics. If you look at the statements, look at this quarterly earnings growth. 10%, 49%, 41%. Is it a surprise that the stock has gone up 60% in just a matter of 4 months, and that too in the US market where interest rates are like what, 2%? Okay, maybe even less than that. Okay, so a stock is giving 60% return in 4 months in the US market, which is a developed economy, is a fabulous return. And that return is backed by growth in earnings and a moderate growth in sales as well. Okay. But that's not the point. We are not looking at fundamentals. Let us focus on the chart. So let's draw the points in the base. We want to see how the consolidation took place. So this is point one. That's point two. I think that's point three, point four, point five. Okay. So there are 5 points in the base. We are looking for minimum 4 points in the base. 4 points means two contractions or two corrections or two consolidations. So this is one correction. This is second correction. Okay. So you have two corrections. So I take point number three as my buy point. Okay. So that's the yellow line. So probably my student entered his order somewhere near this 64.99. I don't know his exact buy price, but it is extremely close to this yellow line. Okay. Depends on whether he put automatic buy stop limit order or a market order. But the buying price is very close to this price. Okay. Because that is the point that we have identified as the buy point. So this is what he saw. 4 points in the base. And one more condition, we look for 10 candles in the base. So we start counting from this candle because this candle has completed the first point. So 1, 2, 3, 4. You count, it is easily more than 10 candles. So blue, green, red, which is the moving averages, the 10 candles in the base and more than 4 points in the base, that's the ideal criteria to buy the stock without even looking at the fundamentals. And this is a very tight, high quality base. So he bought the stock as it came out of this. Let me remove this. So he bought the stock on this breakout day. On this breakout day. So the volume was 1.367 million and the average was 1.372. So it's close to the average volume. We would have preferred that it was more than at least 40-50% more than the average volume, but this is fine. It's near average volume. It's okay. 3.25% rise in a single day. You could give the stock some more time to run. And of course, the stop loss would be 8%. I don't know where he kept the stop loss, but I would suggest 8% stop loss. So that stop loss would go below the low of the base. So which is a very conservative stop loss. And I know the position size he took was 2.5%. Okay. So 2.5% position size, 60% return. So 60% of 2.5 is roughly 1.5% of his portfolio. So he has made 1.5% return on his portfolio in 4 months from just a single stock. Okay. Now that might not sound to you like a fantastic return, but try earning 1.5% return from a single stock, 1.5% of your portfolio, and see how you feel. It feels fantastic. Okay. If you're a real trader, you will understand what I'm saying. It feels lovely. Anyways, so those are the reasons he bought. Now let us go to the weekly chart and do some base counting. Where did he buy the stock exactly? Okay. And was it the right decision to stay in the stock for such a long? And he's still holding on to the stock, still hasn't sold any shares. Okay. So let's look at his decision. So I'll go to the weekly chart. This is the weekly chart. So weekly chart, you have the 10-week moving average line. You have the 10-week moving average line here. Weekly chart, you don't need too many moving averages. Okay. So this is SFM weekly chart. Same stock weekly chart. So first thing we have to do is draw the first base. Okay. So in this case, if you see, the base starts from here. So 2013 till in this area, which is 2023, for 10 years, the stock was just languishing. So the stock was doing nothing for 10 years. Okay. And now suddenly it picks up and it goes up. And my student bought the stock on 19th of April, I guess. So let's look at 19th of April. So somewhere here, 15th April, 22 April. So I think he bought the stock as it was coming out of this consolidation. So he bought it here. So let us mark that point. So on the weekly chart, if you see, he bought here. He took the trade on the daily, but on a weekly chart, this is where he bought the stock and this is where the stock is right now. As you can see, the stock has corrected a little bit, but never closed below the blue line. The blue line is the 10-week simple moving average. You could also call it the 50-day simple moving average. Okay, it's the same thing. So if you look at purely based on the 10-week simple moving average, the decision to remain in the stock has been correct because it has never closed below that blue line with heavy volume. If a stock closes below the 10-week moving average line on heavy volume, that's a sell signal. At least some portion of the stock needs to be sold. But anyways, let's come back to the base. So let's draw the first base. It's very important. So let's draw a base here. So I will take this entire period. Now we are looking at 10 years of data, by the way. Okay. So this is point one, this is point two. Now, after we have identified point two, our next objective is to find out when does the stock enter the blue zone or the green zone, or when does the stock get out of the red zone. The red zone is the lower half. The blue and the green zone is the upper half. The green zone is the upper quarter. Blue zone is the second quarter. So our goal after point two is to wait till the stock comes out of the red zone, which means we are waiting for the stock to recover. We are not buying at the bottom. We are not doing bottom fishing here. Okay. We wait till the stock recovers. Now see, it recovers here. This is the first candle, weekly candle, which enters the blue zone. Okay. First weekly candle after so many years. It's like after 9 years from 2013 till 2022. It took 9 years for the stock to finally recover, okay, from its struggles. So you look at this candle. After this candle, now we are looking for that magic candle. Okay. After this candle, you have three candles consecutively which are below the high of this candle. So that's your first pivot point. Remember, there is a difference between pivot point and buy point. Pivot point is on the weekly chart, buy point is on the daily chart. Pivot point is where the supply is at its minimum, hopefully, because the pivot point still has to prove itself. So the pivot point is the point where the supply is at a minimum, good buying action could come there. Okay. And the buy point is something else. It is on the daily chart where we use the volatility contraction pattern to find out our precise buy point. So this is our first pivot point because after the high of this candle, there are three consecutive lower candles. But this fails because see, it touches and comes down. So now this candle, it also has three. After the high of this candle, it also has three consecutive lower candles. So that becomes our new pivot point. But even that fails. As you can see, it breaks out, never goes up 20%, crashes down. Okay. So let's try to find another pivot point. So this candle breaks that high. So let's take that candle. Okay. After the high of this candle, there are three consecutive candles which are below the yellow line. The entire candles are below the yellow line. And now you see it breaks out nicely. Once it crosses this line, once it breaks out above that line, it starts to move up. Okay. So I think that would be the correct pivot point. This is where majority of the supply was absorbed by the weaker players and the bigger players started to pile onto the stock here. Okay. Even this candle could be taken as the buy point. See, you look at this. If you look at this, if you look at this, after this candle, it still fails. So you could continue looking for the best candle. So this, I think this would be the best candle. This one. Okay. So I would take this yellow line, put it here. After the high of this candle, there are three consecutive lower candles. So see, this is a nice breakout. Remember, pivot point is not the buy point. We are not searching for the buy point. We are searching for the point from where the breakout truly started. If you had bought at this level, your stop loss would have been hit because of this candle. But if you had bought at this level, okay, your stop loss was never hit. Okay. So I would consider this one. So you have identified four candles, after which there are three consecutive lower candles. I would just take the latest one to keep the analysis simple. Okay. Now I will call this base one. Let us give it top right. Okay. So I call it base one. Okay. Base one buy point. The next step is, okay, let's come back a little bit. The first step was to draw the base. The second step was to wait for a recovery from after point two. The third step was try to identify these magic candles, after which you have three candles below the high of that magic candle. The entire candles should be below that yellow line. Once you find the point, the base has to prove itself. Okay, how does a base prove itself? It proves itself when it goes up 20% above the yellow line. So after it breaks out here, does it go up 20%? Yes. So now the base has proven itself. That's the next step. After the base proves itself, now you are free to look for the next magic candle. Okay, next base. And that happens here on this candle. See, from here, when it breaks out, there is not a single candle from here till here after whose high there are three consecutive lower candles. See, every time a candle makes a high, that gets broken out within 2 weeks. So this is the candle, the high of this candle. So I will place a yellow line here. That becomes our base number two. Okay. So that's base two. After the high of this candle, you have three consecutive low candles below that yellow line. And my student, he bought this stock here on this in this week. Okay. I think he bought here 15th. His buy date was 19th April, if I remember from the daily chart. So he actually bought before the formation of base number two. Okay. And if you have understood the base counting, if you remember, when a stock goes from base one to base four, base five, it has already delivered a triple digit return, somewhere between 100% to 1000%. If a stock goes from base two to base four, that would be a triple digit return. So if he has bought the stock here, and if it continues to hold on to the stock while it is forming base 3, while it is coming out of base 3, while the base 3 proves itself, when it goes to base 4, base 5, by the time he reaches base 5, the stock, the price, I would expect the price to be from 65, I would expect the price to be at least 130, 150, something like that. Okay. Currently, it is at 104. And the stock has never closed below. See, the moment it broke out from here after base 1, the stock, there is not a single weekly candle which has closed below the blue line. And the question is, why does a stock remain above this blue line? Okay, for such a long time. See, this is December 2023. We are talking August 2024. That's almost 8 months. Okay, why does a stock remain above the blue line or above the 10-week moving average line for such a long period of time? Okay, imagine you bought here and took a decision that you will never sell the stock till it closes below the blue line. You haven't received a sell signal yet. It's been 8 months and you are making good money. Okay, why does that happen? The only reason why a stock remains above the blue line is three things: sales growth, earnings growth, return on equity. These are the only three things that make a growth stock move up, at least. I am not talking value stocks. I am talking growth stocks. If this stock did not have earnings or sales, the chances are very low that this stock would go up. Okay. So it's a $10 billion company, market value wise. It's a 20-year-old company. It's been in the market for 2 decades now. It is operating healthy grocery stores, valuable company, forming bases, coming out of tight bases. See, this is such a tight base formation. Someone like someone like William O'Neill would call this a flat base. Okay. So it's coming out nicely from a flat base, comes out. See, look at the volume on this candle as it is coming out of the base. Okay. So using my system of identifying buy point, you can even buy before even this candle appears. Okay. You could buy on this candle rather than this candle. That is adding another 4-5% additional to your return. So remember, the pivot point is something which is different from buy point. As per my system, as per William O'Neill's system, this is the proper buy point. As per William O'Neill's system, the pivot point is the buy point. Or to be more precise, 5% distance above the pivot point is considered as the buy range. You're supposed to buy within 5% of that pivot point, as per William O'Neill's book or as per William O'Neill's analysis. But I have my own system of identifying the buy point and on the daily chart. This is a system which I learned from Mark Minervini. So I combined the best of both worlds and I try to get into the stock. Probably if I were trading the US market, I would have definitely jumped onto this stock. But I personally trade only the Indian market, which is enough for me. I don't want to put my money in the US market and take unnecessary currency risk and things like that. Moreover, for Indian citizens, the number of stocks we can buy in the US are limited. Okay, there are a lot of restrictions because of capital account conversion and things like that. Indian market itself is a highly liquid market. Millions of shares are traded per day on each stock. So I don't want to diversify outside. There are a lot of opportunities in India as well. Okay, but don't be under the impression that the US market is saturated or there are no opportunities. Have a look at this stock. This was not very far away. This was just in April, just 3-4 months back. If you had bought here nicely after this nice flat base, this is a picture perfect flat base. Okay. See, the definition of flat base is the distance from point 1 to point 2 should be 10 to 15%, not more than that. Okay. And the minimum number of weeks that it should consolidate is 5 weeks. That's the definition of flat base according to William O'Neill's book. Here you have 5 weeks of consolidation and the distance, I guess it was 7% only, which we looked at on the daily chart. Okay. So it's an ideal flat base. It's a no-brainer trade. Okay. And don't be get worked up about the precise timing of your buy. Okay. Like 65.99 or 65.44. Don't worry about being too precise with your buy point. My argument is, look at this weekly candle. It takes 1 week to create that candle. So you have an entire week to take a decision. It doesn't matter in this week, when do you buy? In 1 week, you have Monday, Tuesday, Wednesday, Friday, Saturday, Wednesday, Monday, Tuesday, Wednesday, Thursday, Friday. Okay. You have 5 days in a week. It doesn't matter on which day you bought the stock. Okay. What matters is you bought the stock in that particular week. Okay. No matter when do you buy on this candle, you are making money. You are making at least 50-60% on the stock. So people get too worked up about the price and buy stop order and limit order, and I don't want to pay 25 cents extra and things like that. If you are getting into a good stock, a fundamentally good stock coming out of a nice base, it's okay to pay slightly higher, like $1 extra or 25 cents extra or 50 cents extra. That's okay, because if you keep worrying about those small amounts, you might miss the bigger picture where the stock has delivered 60% return. So my argument is, it doesn't matter when do you buy during that week, as long as you buy the stock in that week with a 8% stop loss. Okay, so you have enough time to buy a stock. Don't think that a stock will break out and you will never get the opportunity to buy a stock and you will miss the opportunity of a lifetime. Don't get into that kind of thinking. The moment it touches your buy point or the moment it touches your pivot point, start buying shares. Have a calculation done. Let's say you want to buy 100 shares, buy 50, buy another 10, buy another 10. As the stock starts to move up, complete your 100 shares purchase. You will get some average price which is in this candle itself. Okay, and that's a fair price to pay for the stock, given the base counting that we have done, given the contraction on the daily time frame chart, given the market cap of the company. By the way, this is not some small company. Okay, this, look at the average volume on the stock is 6.8 million shares traded. Okay, this is not some penny stock. This is not some small cap stock. It's a big company. Okay, $10 billion valuation and a profitable company. You know, in the startup world, companies get $10 billion valuation without a single dollar of profit. Have you seen those startups? Of course, you have seen those startups. Not a single dollar of money on the table, and the companies are valued at 10 billion, $20 billion. In comparison to that, this is a company which with profits on the table, with accelerating earnings on the table, and valued at $10 billion. What else do you want? So, looking at the fundamentals, looking at the technical factors, I think my student made a very good decision buying this stock here. An even better decision was to hold on to the stock. He's still holding on to the stock. Okay. Depends. Maybe he will cut his position in half somewhere here, or maybe he will just ride the 10-week moving average. Depends on what is happening in his portfolio, because he might have other stocks in his portfolio which are not making money. So, to compensate for those losses, he might have to cut this position. We don't know, because that is an individual decision. That's a personal decision. Okay. But the decision was good, and I have given you full justification of this, of why he has bought the stock exactly here and why not somewhere else. So I hope you understood this. You want to see more information about the company, go here, click on security info. See, it will give you which sector the stocks belong to, which industry the stock belongs to. The industry comes under the sector. The sector is a more broader thing. It gives you the tick size, it gives you the exchange on which the stock is listed, the name of the company, the website of the company, every piece of information you want about the companies here. So, security info and financial, these are the two most important tabs. See, the quarterly, it's growing, the sales are growing, the profits are growing. See, $1.89 billion of sales in a single quarter. $1 billion worth of sales in a single quarter. Okay, that's not a small company. Okay, out of which it is able to retain close to 100 million in that quarter as profit. So that's a 10% margin in a retail business. That's fantastic. And see, accelerating earnings. What else do you want? Okay, where is the return on equity? Let's see if they can show the ratios as well. Statistics, price to earnings. Let's see, return on equity. What is this quarter? Let's see, current return on equity. How much is it? 27%. See, you need minimum 17%. As per William O'Neill's book, you need minimum 17% return on equity. This stock is showing return on equity of 27%. So, return on equity is there, accelerating earnings is there, accelerating sales is there, the technical factors are there. The stock probably belongs to the top 20 percentile of industry. The stock has found a nice tight base on the right side. What else do you want to look for in a stock before buying? All the technical and fundamental factors are in your favor. Just take a buying decision. Just buy the stock and manage the risk. Keep an 8% stop loss. Start with a small position size and then take the trade forward. Right? By the way, one thing I missed here is the base 3, I think, is completed. The high of this candle is above the high of this candle. So we could draw a line here. See, this is base 3. After this yellow line, you have 3 consecutive lower candles. The stock breaks out, doesn't come down much, and it breaks out. So we will call this base 3. So now probably the stock is trying to form base number 4. Okay. So even from base 2 to base 3, that's a fabulous return. See, base 2 to base 3, that's a 25% return. And not much time, like 2-3 months, 25% return. Are you happy with that? Of course, you should be happy with that. Considering this is US market where interest rates are low, right? You have to compare your returns with the prevailing interest rates that you get on your fixed deposits, because here you are taking risk. 25% return in 2-3 months is fantastic. 60% return in 4 months is super fantastic. Okay. So I congratulate my student for giving us this example to discuss. Okay. And there was genuine reason for buying the stock. A lot of factors were looked into before this purchase was made. So please, if you are watching this video, please study this video, watch this video 2 times. Look at what are the factors that I have discussed before he bought the stock. I showed you the screenshot by deleting all the candles after the breakout. Okay, what was he looking for? Okay, those factors, if you learn those factors, you will be finding stocks where those factors come true, and that is the time you should be buying stocks. But anyways, for now, this much information, this much learning is good, and I hope you learn a lot from this video. I suggest that you watch this video at least 3 times. Every time you watch the video, you will learn something new. Repetition is how we learn. I might have said something in this video that you have overlooked, okay, or overheard. But when you watch it again, you might grasp that concept, and that concept will remain with you for your entire life, for your entire trading career. Okay. So maybe something about return on equity has caught your attention. I don't know. But if you listen to all the points that I have discussed, okay, it might help you. So please support this channel. Please like, comment, share this video with your friends, family, business associates. This will help you. This will help them. We are all here to help each other. Okay. Spread this video so that this video reaches like-minded people like you and me. Okay. Thank you so much.